The U.S. markets are currently closed. The last closing price for Nuburu Inc., trading under the ticker symbol BURU, was 48 cents, representing an increase of $0.013 or 2.88% during Friday's session, October 10, 2025. Now, on the surface, a nearly 3% gain might seem like a positive signal, a small flicker of green in a portfolio. But the immediate reality for this stock is that its daily movements are almost irrelevant when measured against the larger, more pressing story. That single-day tick upwards is a distraction from the critical fact that Nuburu is fighting for its life below the crucial $1 mark, a technical and psychological level that separates viable exchange-listed companies from those in the danger zone of delisting. This isn't a story about a minor daily gain. It's about a company with potentially transformative technology whose market valuation is screaming existential risk. The common expectation surrounding Nuburu is built on a very compelling and technically sound foundation. Investors who are drawn to this company usually hear about its proprietary blue laser technology. The narrative is that these lasers are uniquely effective at processing highly reflective metals like copper and gold, materials that are notoriously difficult for traditional infrared lasers to handle. This capability is perfectly timed for major industrial trends, especially the production of batteries for electric vehicles, where copper welding is a critical manufacturing step. The belief is that Nuburu holds a key to unlocking efficiency and quality in a massive growth sector. You see this storyline and you picture a company poised to become an essential supplier to giants, maybe even the next big thing in industrial technology, a stark contrast to the often crowded consumer tech space occupied by names like Apple stock. The expectation is that this technological edge should translate to market dominance and a soaring stock price. However, the reality of Nuburu's situation is a far more complex and sobering picture, one that many online investing platforms might not fully prepare you for. The stock's precipitous fall since its debut via a SPAC merger tells the real tale. It's a story of significant cash burn, competitive pressure, and the immense difficulty of scaling a hardware manufacturing business. The company operates in a field with established titans like IPG Photonics and Coherent, companies with deep pockets, extensive research and development budgets, and long-standing relationships with major industrial clients. While Nuburu's blue laser tech is impressive, the reality is that these larger competitors are also developing solutions and have the manufacturing scale and financial stability that Nuburu currently lacks. An investment here is not a simple bet on good technology. It's a high-stakes wager that a small, financially strained company can outmaneuver industry giants. This isn't a stock you'd typically find highlighted in a diversified portfolio from Fidelity Wealth Management or a SoFi robo-advisor. It's a speculative play that demands a very high tolerance for risk. Looking at the recent trading activity provides more evidence of this disconnect. The volume on its recent 2.88% up day was relatively thin, which is characteristic of a microcap stock where even small buy orders can move the price significantly. This isn't the kind of institutional accumulation you'd see in a stock like Nvidia stock, where billions of dollars change hands daily. Instead, it's mostly retail traders, likely using platforms like the Robinhood app or SoFi Invest, speculating on news or short-term momentum. The stock's chart shows a pattern of high volatility and a consistent long-term downtrend. For anyone doing their self-investing, this pattern is a major red flag. The persistent trading below $1 forces the company to contend with the threat of a notice from the NYSE American Exchange, which could lead to a reverse stock price. While a reverse stock price would solve the price problem cosmetically, it does nothing to address the underlying business fundamentals and often precedes further share price declines. Let's be clear about what Nuburu actually does. The company, based in Colorado, designs and manufactures industrial blue lasers. The physics is what makes them special. Blue light has a much higher absorption rate in materials like copper compared to the infrared light used in most industrial lasers. This means less energy is wasted as reflection, leading to a more stable, higher quality weld with fewer defects. This is a significant advantage in applications like welding the copper foils and connectors in electric vehicle battery packs, joining components in consumer electronics, and even certain aerospace applications. Their business model is straightforward. Sell these advanced laser systems to manufacturers. The potential market is undeniable, but the path from having a great product to building a profitable, sustainable business is fraught with challenges, including the high costs of manufacturing, the long sales cycles for industrial equipment, and the need for continuous expensive R&D to stay ahead. Managing an individual brokerage account with positions like this requires a different mindset than holding Fidelity ETFs or Fidelity mutual funds. It requires active engagement with quarterly reports, cash flow statements, and industry news, something that an automated intelligent portfolio from a provider like Schwab is simply not designed for. Analyzing their financial position reveals the core of the risk. In its past financial reports, Nuburu has demonstrated revenue growth, which is a positive sign that there is market demand for its products. However, this has been accompanied by substantial operating losses and negative cash flow. The company is spending heavily to build its inventory, fund operations, and invest in research. This cash burn rate is the ticking clock. Without a clear and imminent path to profitability or a new injection of capital, the company's future becomes uncertain. This is where the risk of dilution comes in. To raise funds, Nuburu might have to issue more shares, which would decrease the value of existing shares. For a shareholder who bought in at a higher price, this is a painful prospect. Many investing sites might show the green percentage for the day, but they don't always effectively communicate the balance sheet risk that is fundamental to a company like Nuburu. It's a classic battle between a promising growth story and a precarious financial reality. Comment below what you think Nuburu's biggest hurdle is right now: cash flow, competition, or scaling production. Looking forward, the future of Nuburu can be viewed through a few distinct scenarios. The bullish case, the one that fuels the expectations, hinges on a few key catalysts. First, a major contract announcement with a top-tier automotive manufacturer or battery producer would be transformative. It would validate their technology at the highest level, provide a significant revenue stream, and likely send the stock soaring. Think about the impact a partnership announcement has on even a large company like Tesla stock. For a company of Nuburu size, it would be monumental. Another positive catalyst would be a technological improvement that dramatically lowers their production costs, allowing them to compete more aggressively on price. The Interactive Brokers platform might light up with buy orders if such news were to break. However, the bearish scenario is grounded in the current reality. If the company continues to burn through its cash reserves without securing new, non-dilutive financing or landing a game-changing contract, it could face serious operational challenges. Competition could intensify, with larger players launching their own effective blue laser solutions, squeezing Nuburu's margins and market share. In this scenario, the stock could face a delisting and a struggle for survival. This is the risk that active traders using Fidelity trading platform or similar tools for interactive broker stock trading must constantly weigh. The convenience of the Fidelity mobile app or Robinhood stock trading makes entering a position easy, but understanding the downside risk is what separates successful speculation from simple gambling. Then there is a middle ground scenario, a potential acquisition. A larger industrial technology company, recognizing the value of Nuburu's intellectual property and engineering talent, might see an opportunity to acquire the company at its current depressed valuation. For existing shareholders, this could be a positive outcome, offering a premium to the current market price, though likely a fraction of the stock's initial SPAC valuation. This is a common endgame for smaller tech companies with valuable niche technology but insufficient capital to scale independently. It's a possibility that should be part of any thorough investment help or analysis concerning this stock. The world of online investment is filled with these kinds of high-risk, high-potential reward situations. In conclusion, the story of Nuburu is a perfect illustration of the tension between a compelling expectation and a difficult reality. The expectation is that its superior blue laser technology will inevitably lead to success in the booming EV and electronics manufacturing sectors. The reality is that of a small company facing immense financial pressure, fierce competition, and the daunting challenge of scaling its operations before its capital runs out. The market has priced it as a long shot, and for now, that seems to be the most accurate reflection of its reality. The content shared on this channel is for educational and informational purposes only. It should not be considered as financial, investment, or legal advice. Always do your own research or consult a qualified financial advisor before making any investment